Okay, good day, everyone, and welcome to all who are participating both here with us in person and online. We are here for the Geneva presentation of the joint IFC WTO report on trade finance in West Africa. So welcome all, of course, to our friends from IFC, and I will refer to them in a minute, and my colleagues from ERSD. So let me make first a few contextual remarks, and then I will move to introduce our presenters. The report was launched on October 12th of this year in the context of the IMF World Bank 2022 annual meetings by the WTO Director General, Dr. Ngozi Okonjo-Iweala, and IFC Managing Director, Maktar Diop. Susan Lund, Vice President for Economic and Private Sector Development, and myself, we also participated in the launch of the event. Now, the Washington launch, I think, was very well received and attended. However, it is important that this public good, that is the fruit of the collaboration between the WTO and the private arm of the World Bank Group, the International Finance Corporation, also be presented to the WTO membership, the WTO chairs, and the Geneva-based community of interested researchers. Last week, the report was also presented to the financial community in West Africa at the African Financial Industry Summit in Lomé, Togo. Please note that since the Washington presentation, that report has been translated in French. This version of the report was uploaded on both the WTO and the IFC websites, and a few paper copies are available in the room along with the English version. Let me also remind the broader context of the report. A year ago, the WTO Director General and the IFC Managing Director pledged in a joint public statement to enhance existing cooperation to improve the analytics, identification, and detection of trade finance gaps with a view to better direct capacity building and other resources where unmet trade finance demand is greatest, particularly in Africa. They noted, and I open quotes, developing country members regularly identify a lack of trade finance as a major obstacle to participating in global trade, all the more so for micro, small, and medium-sized enterprises and business led by women. They also said, working together, experts from our two organizations will be able to better analyze, detect, and expand these trade finance gaps, and we believe that a significant share of trade finance gaps results from knowledge gaps. Now, the first report focused on the main economies of ECOWAS, the Big Four, Nigeria, Cote d'Ivoire, Ghana, and Senegal, accounting for over 80% of trade, GDP, and bank assets of the region. This study is timely because on the wider scheme of things, trade finance gaps have further increased during the COVID-19 pandemic from an estimated $1.5 trillion in 2018 to $1.7 trillion in 2020. The IFC and other multilateral development organizations have stepped in significantly to support essential imports and exports of low-income countries, particularly in Africa, during this period. The demand for their facilities remains at historical levels in current troubled times. Now, behind the broad trade finance gap numbers, there is a great heterogeneity of regional and sub-regional situations about which we do not know enough to be able to act upon. This is one reason why we engage in such a deep dive, making of Western Africa a pilot study. It is based on the IFC's extensive survey of local financial institutions in the region. Let me now introduce the team of speakers. A first panel of speakers will present the survey, the main findings and conclusions of the report. It is composed of Natalie Loit and Denis Medvedev from IFC, respectively Director of Trade and Supply Chain Finance and Director of Economic Policy Research, and Marco Buon from the WTO Secretariat, Counselor for Trade Finance and Coherence. The report's individual chapters will be presented by Alexandros Ragoussis, Senior Economist, IFC, Alexei Timofty, Trade Specialist, Economic Research at the WTO, and Eddie Beckers, Counselor here at the WTO as well. The total of presentations will last about 30 to 40 minutes, and they will be followed by some 30 minutes or so of Q&A from the floor or from the Q&A feature of Zoom for online participants. I also want to note that the session is translated and live streamed on our YouTube channel. So without further ado, and big thanks to all of us who joined me here, because they are actually the ones who did the report, not me, with a big thanks to all of them for the very hard work. Let me now pass the floor to Natalie to start with. Thank you.
Thank you very much. We are very pleased to present the results of this study, focusing on 4 countries in West Africa. Not only because it is of interest to the general community, but also because it will help us at IFC develop a program specific to these countries and the region overall. So, Dennis, we'll start with the first slide.
Thank you. Thank you very much, Natalie. Thank you, Annabelle, and the WTO team for the warm welcome, and particularly for the great collaboration that we've had in working on this report. Are we advancing with the slides? Mm-hmm. Yes. Okay, very good. So I will make a few remarks. I will pass it on to my colleagues, but would really like to leave the room for the technical team to present more detailed results, and of course the real value of this, which is the engagement and discussion with the audience. Also, thank you to all of those who are here in the room with us, as well as the audience online. So the first message that I want to share is going to be no surprise to this audience. Despite significant progress in West Africa in terms of advancing the integration with the world through trade, there still remains room for expansion. Although the numbers of exporters and importers have been increasing, the number of products being exported has also increased. What we also see is that both in terms of participation in global value chains, as well when we look at the trade costs, there has not been enough progress on that agenda to truly leverage trade as an instrument for development in this region. And this is why we started looking at some of the challenges. Of course, the challenges are many, and it is beyond the scope of this report to even enumerate them, let alone to get in the details. But certainly trade costs are a big part of the story, and we notice that these trade costs are both significantly larger than the costs of exchanging goods domestically, but also these costs in many cases have not decreased over time as they have in other parts of the world. So, and as part of that cost, we focus on trade finance. So you probably, all of you know what trade finance is, but essentially it's an instrument that helps bridge the gap between when the exporters would like to be paid and when the importers wish to pay. So the exporter would like to be paid on production or shipment of goods, and the importer, of course, would like to pay after they receive the goods. So in order to make the system work, there needs to be access to finance to allow for these transactions to take place. There are a number of solutions that enable this, but what happens is that in developing countries, access to these facilities tends to be a bit constrained. As Annabelle mentioned in her remarks, in order to understand the magnitude of the potential gap in terms of the availability of trade finance, as well as some of the reasons behind that happening, we conducted an extensive survey of financial institutions in Côte d'Ivoire, Ghana, Nigeria, and Senegal, asking financial institutions about the provision of trade finance, asking them about also some of the reasons why some applications for trade finance may not be approved. And we will hear much more about this during the presentation for this report. Lastly, I will say that, of course, the big innovation here is to bring the costs of trade finance into the broader discussion of trade costs, using a lot of the insights and modeling capability of the WTO to then link trade costs to potential increases in trade. And with that, I will pass it on to my colleague.
Thank you very much. Next slide, please. What the survey says, if we were to bring it to its basic results, is that trade finance is not only scarce, in ECOWAS 4. We'll call them ECOWAS 4 countries. But when it is available, it is costly. We were able to, and that would be explained in the presentation, we were able to estimate that trade finance is supporting about 25% of trade, imports and exports of those countries, which is relatively below the African average of 40% and the estimated global average of 60 to 80%. What this means in practice is that traders in the region are more likely not to use trade finance than to use trade finance, thereby paying their imports mostly cash in advance instead of using trade finance facility like letters of credit, or they are more likely to finance from their own cash flow the exports and then the process of production leading to exports, rather than to get what we call pre-export shipment finance to do so. And engaging own funds without a full guarantee to be paid or to receive the merchandise is in practical terms an impediment to trading and being at a disadvantage as a firm vis-à-vis competitors which are in a position to get that trade finance. So that's a key result. The second thing is that when asking for trade finance, those companies which are asking have a chance of rejection of about a quarter, and particularly affecting more disproportionately small and medium-sized enterprises having a larger rejection rate than the bigger firm. The third is when available, when that 25% is accessing trade finance, it is at cost significantly higher than the average of, let's say, other emerging economies. And that is not only visible from letters of credit, but it's also from trade loans, and that the details of that would be explained as well. And finally, a headline a number that we were able to generate through this integration between trade finance cost and trade cost is that if trade finance was available, let's say to the African average, that is, would increase from the current 25, the measured 25% to 40%, then trade flows in the region could increase by 8% every year, so 80% over 10 years. And if the availability of trade finance and it was increased and its cost reduced to the global average, which is a sort of longer-term objective, then the increase would be 16% per annum for trade. So increased availability and reduced cost to the, let's say, international benchmarks and standards would increase trade by 16% every year, so 160% for 10 years. So with this, I leave the floor back to Dennis.
Thank you very much, Mark. One key point that I think we should go to the next slide if we can. Yes. Now, a key point here is about the opportunities that could come with access to increased trade finance. So Mark mentioned the overall envelope, but there is also important heterogeneity in terms of the types of products that could be particularly benefited by improved access to trade finance. And here, one of the findings of the report is calling attention to the fact that some products, such as capital goods or intermediate inputs, are actually more intensive in the use of trade finance than other categories such as consumer products. And we know that for outcomes like participation in the global value chain, for example, or even producing more capital-intensive, more innovation-intensive goods domestically, it is important to have access to these intermediate inputs and also to capital goods, which come with embedded technology and embedded knowledge. So not only is the lack of availability of trade finance potentially constraining overall trade envelope, it may be a particular constraint for the types of activities that may be especially beneficial to growth and development of these countries. And with that, I hand it over to Natalie.
Thank you, Dennis, and thank you, Mark. So I just want to comment that what is seen as a gap overall is also an opportunity to do more and provide more support to grow trade finance in West Africa. From our point of view, there is a lot we think can be done to reduce that trade. And the first thing that should be done is increase the availability of trade finance by supporting the financial institutions in the region establish stronger correspondent banking relationship. So IFC provides guarantees to facilitate the relationship between issuing banks and correspondent banks. And we feel that there is a need to increase the number of relationships. That can be done through many programs that DFIs are offering for the support of trade finance specifically. That's one of the things that we can do. And IFC and WTO are, for example, doing a joint trainings to banks on the topic of compliance, trade-based money laundering compliance, which we think is a very strong asset that the issuing banks can use to convince more confirming banks to work with them. Of course, with more confirming banks, you create more competition, and that should, in turn, have some impact on costs. Second, we think that there are opportunities related, for example, to the free trade agreements. So we are very optimistic that the new Africa Continental Free Trade Agreement will support more transactions happening within Africa. And we are here, IFC and other multilaterals, available to support those transactions. A third lead to expand the access is to work with SMEs. We need to help them present themselves to the local financial institution in a way that will make it acceptable to local institution to finance them. And so that is something that we're also working with specific workshops that are organized also jointly with WTO to train the SMEs. And then finally, we always say that there is more work to be done on technology and digitization of documents. The COVID crisis has shown to us the limitation of a very heavy paper-based trade transactions. So we are seeing some progress being done in that area, and that should also impact resolving the financing gap that we are still seeing. We are working to collect data on the performance of the trade finance instruments, and because we believe that having strong data will help support decision making. And we are working also on effective enforcement of the rules for collateral. We're trying to reduce the amount of collateral that SMEs have to provide to get trade finance support, but we're also working on strengthening the legal enforcement of the rules so that the banks feel more comfortable lending to SMEs and providing the support for trade finance. So in effect, all these actions have an objective of increasing the availability of trade finance, reducing the rejection rates that we are seeing, which are very high, and indirectly reducing the costs by providing more support. Thank you. So I should go to Alex next, who is presenting the key results of the study. Thank you.
Sure. Thank you, Natalie. So by this point, you have a good overview of the content of the report from the summary of my senior colleagues. Going more into the specifics and to the numbers offers some additional insights, which we will try to summarize. First, starting by the context, by the question of how important is trade for these four countries. And the answer is quite a lot. So even in the middle of the crisis and in 2021, the four countries combined traded more than $200 billion US dollars in goods and services. More than half of that was Nigeria, 111 billion. But you see substantial volumes also from coming in and from these four countries. And also, what is important, and you will see in the next slide, is that trade in the region has also been very dynamic over the last 10 years. So we see the products imported and exported have gone up. There are more traders, more importers, more exporters, more markets reached, and also the global footprint of exporters. Their export market shares, with the exception of Nigeria, have increased over the last 10 years. What is also very interesting is that the global footprint of exporters has increased, mostly not because of compositional changes in trade, and we get these insights from Shift-SIR analysis, not because the growth of their trading partners or growing demand in the products that they commonly export, but mostly because of the increase in their performance, like greater competitiveness for the exporters, which is a very promising pattern to see. But trade lacks sophistication, echoing the remarks that Dennis made.
This is really what is dragging back, if you like, the trade potential of the countries, in addition to trade finance. Raw materials, we show in the report, make up more than 70% of exports from the 4 countries. And also imports of non-consumer goods, like capital goods, intermediate goods that enable production, enable participation in global value chains, lag behind the global average. Trade costs, and what you'll see in the next slide, have also remained persistently high. What you see here is the range of values of the WTO trade cost index, which answers the question of how much higher is the cost of trading internationally than the cost of trading domestically, of selling domestically. And what you see here is that the range for the 4 countries with their 10 major partners is between 3 and 5 to 6, which is enormous as a gap. It is excessive. What is additionally interesting here is that while over the last 10 years, the cost of exporting has moderately declined and gone down, there has been improvement, there has not been the same improvement on the import side. And this is one contributor to the trade cost on the import side is, of course, trade finance. To get a more clear picture of the state of trade finance, we turn to banks for a survey, and I pass on to Alexei, who will give you more information on that.
Thank you. And in the second chapter of the report, we've outlined the main findings of the survey led by IFC colleagues. And here we would like to congratulate their team for a tremendous effort and for surveying virtually the entire banking sector and banks in the 4 countries. So the beginning of August 2022, 89 banks had provided information on their trade finance, both IFC clients and non-clients. And by the end of September, over 100 banks had replied to the survey. So with this data collected, we have a good understanding of the 4 markets as far as trade finance is concerned at that point in time. And as you can see on this slide, the size of the bank intermediated trade finance was totaling around 42 billion annually in the 4 countries. The breakdown by country is also provided. And as you can see, Nigeria, not surprisingly, is in the lead position in terms of total volumes, which is 21 billion. The average percentage of bank intermediated trade finance in the 4 countries is around 25%. And again, this has already been mentioned. The number falls short of the average African trade finance figure, which is around 40%, and is around 3 times less than the global average that is in between 60 and 80%. So why is this important? As you can see on the next slide, the unmet demand is estimated in this report to be around 14 billion. And the rejection rate of about 25% was used to assess the extent of unmet demand for the 4 markets. So low coverage is linked with high rejection of trade finance applications. So according to the survey, 21% of the number of requests and around 25% of the volume of requests were rejected. So we use this information to calculate the unmet demand by multiplying the total trade finance assets after extrapolating over the remaining banks that are unobserved, and obtaining a rough estimate of the unmet demand. When we looked further on the next slide, please, we looked further into the reasons of rejecting trade finance. So I would just, there is, as you can see, is a longer list of reasons, but I would focus on the lack of correspondent banking limits, which was often highlighted, as well as the collateral requirements and the perceived high credit risk of the obligors. That next slide is highlighting the high prices that are being charged in the 4 surveyed markets. So as you can see, on average, LC price ranges in between 2 to 4%, while the global average is around 2%, and in the high income economies, that number would be at 0.25 to 0.5%. So, or in terms of when we look at a short-term working capital pre-shipment facility, the prices observed were around 13% in Cote d'Ivoire and Senegal, and around 25% in Ghana and Nigeria. So we tried to look into the reasons for these high prices, and I will just list some of them. So lack of competition, the high concentration of the trade finance providers was one of the reasons. And just to give you a reference, around 2/3 of the trade finance supply is offered by the top 10 banks in the region. Lack of product diversification is another reason that drives the high prices, and that means that in the 4 countries, the traditional trade finance instruments such as letter of credits or pre-export financing are the most utilized, while newer versions of newer forms of trade finance, such as supply chain finance, are rarely used. The collateral requirements and the cost of funds for smaller trade finance banks drive the costs up as well. On the next slide, please. This slide just shows the correspondent banking shortage that persists in the markets. So, like for example, in the case of Ghana, only 30% of the banks have more than 10 correspondent bank relationships, that compares negatively, basically 3 times less than the African average. That being another reason why prices are high and not enough to service the demand in those markets. With that, I will move to the 3rd chapter to my colleague Eddie Becker.
And next slide, please. Thanks a lot. So we used the inputs. We used the data collected that were just presented by Alexei. We used them in our WTO global trade model. How did we do that? The key point is there that we integrated them into the trade costs, and more specifically, we modeled trade finance as part of import taxes. Why part of import taxes? Because we argue that If there is a change in the cost of trade finance, it's going to be reflected in changes in rents earned by the banking sector. Obviously, you could say then you should model the banking sector. That was way too ambitious. We didn't have the tools for that, so therefore we integrated. We modeled the cost of trade finance as part of trade costs, and more specifically as part of import taxes. How did we do that? We identified that there are four types of four ways in which a trade can be financed. So it can be with letters of credit, it can be with export and import loans, it can be with cash in advance, or it can be as finance through exporters. So exporters could pre-finance. And so we use data collected in the survey on to identify the share of each of these four types. And then on top of that, we needed data on the size of the cost of financing international trade under these four types of arrangement that you could choose. And so that was also to a large extent based on the survey, but there we also complemented this with information from the literature. What costs are we speaking about? There are two types of costs included. So that is the cost of risk, which is based on information on cost of on default, and on the other hand, the cost of the fees, like the LC fees, for example. So we included all these ingredients, and then we get average cost of trade finance, basically. And that brings us to the step. Then we run four counterfactual scenarios, which you can see on the slide. So what we did is we in the counterfactuals, we work with the two margins that could be changed as a result of policy. First is access to trade finance. So here we're talking about an increase, for example, in the share of trade that is covered with letters of credit instead of, for example, with cash in advance. And secondly, there could also be a change in the cost of trade finance. So the LC fees, for example, could change. And so then we come to these four scenarios. Under the first scenario, we only look at a change in the share of trade that is supported by trade finance. Then we have scenario 2 and 3, where we look at the price of respectively letters of credit and import and export loans. And then finally, we combine these three. Next slide, please. So here we see the results of the simulations. And what I think there are three things remarkable, or I would like to highlight three main things from this table. First, we can look at the right ECOWAS for the total effect. We see the number that was highlighted already in the introduction. We see a projected increase of 7.84% in exports and 7.57% in imports. So that is about 8%. Then secondly, what is interesting is the distribution between the different types of shocks. And so we see that increasing the coverage of trade in the very first row provides the biggest contribution to the counterfactual increase in trade. Why does it deliver such a large contribution? That is because when there is a larger coverage of trade finance, it means that traders, importers and exporters, they can start working more with letters of credit or with export and import loans, which means that they will have to run less risk. And also they will have to pay lower fees compared to when they would have to finance their trade, the trade themselves, because they would pay higher fees. And so we see that this brings quite a big contribution. Then in the third and second row, we see that the contribution of reducing the margin, the costs for letters of credit and for trade loans, that contribution is a bit smaller. Then the third thing I would like to highlight is if we compare the different countries, we see that by far the largest projected increase comes from Senegal. And you see the distribution between the other countries. The reason for these differences is what we find in the survey. What we find in the survey concerning the baseline level of coverage of trade finance. Yeah, so in Senegal, it turns out to be really low. And so in the counterfactual, we say, okay, suppose that the coverage of trade finance would go up to the African average to 40%. Then if you start from a very low starting point based on the survey in Senegal, then of course we're going to get a bigger increase, projected increase in trade. Next slide, please. Yeah, so here we have the same projected numbers, but now if we would increase the coverage of trade finance not to the African average of 40%, but to the global average of 60%, and obviously we see that there is now a bigger contribution from the first row, the coverage of trade. Okay, thank you. I hand it over to Mark, I think, for the concluding remark.
Oui, merci beaucoup. Thanks very much. We will finish the presentation with this. We have a number of questions, either from the floor or remarks. We encourage them. You can use also the question and answer function of Zoom in order to make questions and remarks that we will be happy to answer now. Alors, je vois ici Monsieur Seka, le représentant de la Côte d'Ivoire.
Merci Marc de me donner la parole. Je voudrais saluer les éminents experts de la SFI et de l'OMC qui ont réalisé cette étude sur le financement du commerce dans les 4 pays d'Afrique de l'Ouest qu'ils ont dénommé COAS. Effectivement, nous accueillons avec beaucoup d'intérêt, grand intérêt, cette étude en ce qu'il constitue la matérialisation de la coopération fructueuse qu'il existe entre l'OMC et la SFI. Cette coopération, il faut le rappeler, a été initiée sous le leadership de la directrice générale de l'OMC et du directeur général de la SFI.
Thank you very much for the comment statement, which we'd like to maintain. 2021, we were expecting tangible results, and I think this study is one of such results. For our country, it's also a logical phase of WTO and IFC action in our regard. Once these 2 institutions organized in May 2022, they organized a national workshop on international finance in Côte d'Ivoire, a workshop which was very interesting for national interested parties. So my delegation would like to take this opportunity to thank the teams of the WTO and IFC for this national activity, and once again express our gratitude to the Director General of the WTO as well as the Director General of the IFC, who made comments at the opening of this workshop, which bears witness of the 2 DGs in this subject matter. This was defined as one of the main obstacles of the participation of our country in these activities. So it's something very much dear to our heart, and we'd like to thank you for shedding light on that subject. In fact, the study which you've just presented responds to a need which has been expressed for a long time here at the WTO at the time of different various meetings, and represents for us a significant contribution and a necessary effort of the 2 institutions to better define the gaps, the weaknesses, the constraints and difficulties and challenges which our countries face when we are seeking finance for international trade. The conclusions of the study carried out by the experts of the 2 institutions, we just say, are certainly not very encouraging or reassuring for us, but they have the merit of teaching us about the real situation of the market for trade finance. we find ourselves now, henceforth, in a situation of a patient who's very unhappy at the diagnosis of the doctor, but is at the same time slightly reassured because at least they've identified his illness and understands the scope of it. So you didn't stop there. You also proposed remedies. So we know now that there are remedies. We just have to get together to implement these remedies. But I did want to mention that several points in the study were emphasized, and I think it's very important to come back to them, to insist on them, even though your presentations already did this earlier. One of the points is that trade finance gap was assessed by $14 billion for one, and for Côte d'Ivoire, you assessed $3 billion. But these are all trade opportunities that we've lost, and it's a real problem for us. The part of the coverage of trade finance you assessed at 25% in the ECOWAS 4, even though there was 33% in Côte d'Ivoire. And what's striking is this share is very far from the international standards that could go up to 80%. So for us, the problem is that when you have financing available, which only covers 25% of your need, whereas your partners across from you are able to cover their needs up to 80%. There's a huge gap, which means that the competition isn't a fair one, really. So one of the conclusions also that strikes us, at least as far as Côte d'Ivoire is concerned, which is a country whose economy, I was going to say, is strongly based on agriculture. We see in this study that agriculture is one of the sectors that has the most need for trade finance. According to your figures, it represents 25% of the global needs of finance, trade finance. So we think there has to be, and we suspect that there is a link between this situation and our reliance on agriculture in our country. We have to look at these figures and find a solution for trade finance in agriculture if we want to get ourselves out of this situation. But one of the conclusions that our attention was drawn to is to note that each time there's a gap or a weakness, the entities or the people who suffer the most are the SMEs. You pointed to that in your study. Today, the SMEs pay a higher cost for trade finance. The study certainly mentioned 7 to 9% more, whereas the major companies only pay 4 or 5%. That does show you already the difficulties that SMEs may face when they need to find trade finance. It pointed out also that the rate of return, the return rate is rejection rate. We understand that the SMEs don't always have the necessary resources or capacities to meet the bank's criteria. So we might have to work on that to find solutions. But in fact, one of the conclusions also that we saw the strong concentration of the trade finance market. I think you mentioned, unless I'm mistaken, that approximately five of the major banks of the region represent about 50% of the trade finance supply, and the financing goes to major companies again, and here again hurting the SMEs. And this strong concentration is a real problem in itself, because even if the trade finance existed, it's still not accessible to those who need it the most. And your study says that if we made efforts to broaden the coverage for ECOWAS we could gain some $6 billion. But even if we had a lower ambition to come up to the African level, it would still be $3 billion more. I think Cote d'Ivoire, you said $1.9 million more if we raise the standard, and $1.9 billion, we'll have to say that's approximately 7.3% increase in trade for Cote d'Ivoire. This 1.9 billion represents 7.3 of international trade for Cote d'Ivoire. In other words, if we were able to meet that objective that you mentioned, we would have an increase of our trade of 7.3%. That's not nothing. That was considerable as far as we're concerned. So all these elements should lead us to look very carefully at all the recommendations you made, especially those having to do with improved access of SMEs to trade finance. There's no question that this study also sheds more light on the real situation of trade finance, and it does come and enrich work that we're doing here at the WTO within the working group on trade, debt, and finance. We have a working group here where we have been working for a certain amount of time trying to think about these issues, and I think this study has a strong resonance with everything that you've proposed. I think Cote d'Ivoire submitted in that context a proposed test on trade finance, which is being discussed by members and which aims precisely to propose the means to facilitate SMEs to trade finance. You'll understand why I keep coming back to this question, which is very important for us. And we'd also like to take this opportunity to make an appeal to all members of the WTO so that the conclusions of this study could accelerate the pace of our work so that we can adopt a roadmap on trade finance by MC13. This is an objective we set ourselves, and I hope that we'll be able to do it as soon as we can. Cote d'Ivoire, we remain active and committed in our work with all the members to achieve the objectives we've set, and also with the WTO, the IFC, and other relevant organizations. So I'd like to conclude by asking a question that I'd like to address both to WTO and IFC. I was talking about a patient who's ill in the hospital, and now that you've diagnosed the illness, you've told us what's wrong, and you even prescribed you gave us a certain prescription. Or I'd like to now know, what is the next phase that you're planning for us to help us on this road, on this path? I think Nathalie Loy said earlier that IFC had a program for those countries, 4 countries of ECOWAS 4. Could you tell us a little bit more about this program? Yes, thank you for your comments and for the presentation of the report which you made to us, covering all the figures for Cote d'Ivoire. So thank you for having read the report very carefully. We appreciate the collaboration and Cote d'Ivoire was selected as a pilot for our pilot program for the workshop we set up. This workshop is one of the elements, one of the workshops, which is a solution to the illness that you mentioned, because certain features that we see in Cote d'Ivoire the rejection rate of requests for trade finance in Cote d'Ivoire is of 2/3 for 2 reasons. One, the fact that banks considered the risk of the applicants too high, and that they don't think there's insufficient collateral. These two factors are represented, but in Côte d'Ivoire, this represents 2/3 of the rejection rate. So that's a discussion that goes beyond trade financing. It's also a discussion on the risk assessment by financial establishments and their knowledge of the way SMEs work, as well as a problem of knowledge and communication of data between the SMEs and their banks. It's difficult. It was a subject which was discussed at the workshop. It's a subject that we could certainly work harder on. The second thing is the concentration on a small number of banks. As we mentioned when we analyzed the study, this is one of the causes of an increase in costs, because the offer is very limited to certain establishments, which are usually the biggest banks, and they themselves have a large number, have a large clientele, and so they're therefore not very interested in going to other sectors, which particularly SMEs. So what we're trying to do, another thing we're trying to do, is to try to increase the number of banks who participate in our program so that more people can benefit. This is one of the objectives we have, that is to increase the number of banks participating in our program. And the third reason is that we hope that banks in Côte d'Ivoire can have more access to international banks. At present, we mentioned the figure of 7. That's very few to have only 7 relations with banks. So the more we can finance diverse operations, the more we can optimize costs. So those are 3 tracks to study, which should enable us to improve access to trade finance in Côte d'Ivoire. Thank you very much for your comments.
So I just wanted to say that in addition to the workshop, which was carried out by WTO and the IFC, there's also a series of follow-up actions to build relationships with financial institutions as well. And in Niamey, there were also conversations which did follow up the discussion that we had. Mark, would you like to add something?
Merci.
Thank you, Natalie. Yes, now, if we look at cause and remedy, well, then, of course, there are international causes. We've discussed those a little. The way that banks started to correspond after the financial crisis, of course, that was at the end of the 2000s. Here again, the market's quite concentrated, but institutions really showed themselves to be much more risk averse and concentrated on their home markets, or perhaps the more profitable markets. And then there were also questions relating to the capacity of these big international banks having to meet conformity requirements in different markets around the world as well. And sometimes this would be done with the national regulator, but huge cuts were made by these large banks. You've probably seen this, the way that these large international banks participate in international financing, export financing, or import financing. They are key for the country. And in certain countries such as Ghana, we see this. The Cocoa Bud Export Program, which is the annual export pre-financing exercise. Well, the financing comes from just a few banks, and the withdrawal of some banks from that market has left gaps in the financing. Now, the question then of international connections and international links is a very important one. Now, the question is, how can we attract not necessarily the banks that left the markets, but in fact to attract new banks, either regional banks or those which have not necessarily got a global network, but perhaps a network that, let's say, is transcontinental, perhaps between Africa and the Middle East. The question, I think, is one of being able to justify the conditions for local banks to, in fact, to speak to clearing banks to make sure that the security conformity, that the due diligence has been done, etc., which are demanded today. And that is the reason that the WTO and the IFC together, in fact, do provide quite a lot of technical assistance to local banks in Africa, not just in Côte d'Ivoire, but in other countries as well. It's a question about making sure that they can act in conformity with the rules and making sure that they can take part. If we were looking at the savings structure, the investment structure around the world, there are countries where the savings rate, and this might be where GDP per capita is quite low, and we see that the savings rate is also low. So we see that the financial systems assistance to the rest of the economy, let's say, in fact, the participation of the system is quite low. So part of the work that needs to be done is to export financing to countries, whether this be trade financing or financing for other reasons. But it's very important for those banks and for those institutions that have an excess of savings to be able to invest them in countries which have a lower savings rate, through financial institutions which act in conformity, as we've said. And on this issue, both the IFC and the WTO, since the arrival of our Director General, we've trained about 600 bankers, mostly in Africa, on the questions of conformity. And we're not the only ones to be carrying out this technical assistance. Now, of course, there are local questions. And here it's often about simply getting the financing moving. There's often local financing available. There are savings which are not being lent. So it's sometimes a question of, let's say, prodding banks into being less risk averse. I can't find the word, but there's a sort of coalescence. It's perhaps spinning round a little. There are large banks that are attracted by large businesses. They're attracted to larger banks because they have better links with actors abroad. So we end up in this vicious cycle, and the banks approach large enterprises because they seem to be less risky, or it's a risk that we know better, or the risk for international trade is lower. And we know that risks do exist at the local, regional, and international level. In fact, international financing is one of the is an investment area where there are the least defaults, in fact. International trade is probably the place where there is the biggest difference between risk considered and actual risk. One of the questions which was brought up is a positive way of considering risk with new actors for those who have not got a lot of experience in this kind of financing, or even with exporters. That is to say that it goes hand in hand with the high growth rate of some of the countries that we looked at. This might be urban growth, so there's a lot of building. It's really a question of risk assessment. Now, banks tend to be quite conservative in their risk assessment. We arrive on the market, we don't necessarily give information which makes investees look attractive. It might not be that standard information is furnished, for example. But the information about the risk of default, company turnover, and all of the other information, it's not necessarily accessible to the banks. And something that was recommended in the report is that fintech businesses, these financial technology businesses, are in fact now calculating payments and how frequently payments are being made. This is through apps. It's not necessarily through traditional means. They can look at when payments are made. They can look at when orders are made. And these fintech businesses are able to analyze the data. And now it's relatively present in Africa, but it is increasing more and more. There are now businesses which are using these data, which are recorded by mobile phones. It might be national data as well. And it does give an overview of the business at the moment when they go to make exports. And we think that here there is perhaps some progress that can be made, and there's low-hanging fruit there. Another piece of low-hanging fruit would be simply reducing the costs in the production of some products that can call into question, in fact, the financial balance of the situation. It might be that the interest rates are too high, for example. Now, of course, if something is too expensive, they're going to say no. Now, so here we've got a few clues. We don't necessarily have all the answers yet. Of course, we need to continue to look at the efficiency in the analysis of these applications, for example. We need to look at the method that applications are made and look at how these are managed by financial institutions. Perhaps we can improve their efficiency. There are also more innovative products, such as value chain financing, or even financing for simply for bills. Now we consider that there is a lot of potential in this product. Of course, it's not currently regulated. There's this question of collateral, which Natalie brought up. And again, this is an important reason for applications failing. Now, of course, the collateral in the world of trade is the product itself, and they are the goods. So, of course, the goods can be seized when payments are not made, for example. But actually, the default rate in international trade is quite low. It's also very simple to seize any goods, and it's then reasonably simple to sell goods which have been seized. And it's about 70% of seized goods which are able to be resold without too much issue. In certain low-income countries, it doesn't quite work as well. And of course, this depends on the local context. We need to understand. But this is a dialogue that we've had with some local bankers. If you've got your hand on the goods, even if you consider that there might be a high risk of default, why is it problematic? There's never really just a problem and a solution. In fact, there are a series of problems and a series of possible solutions, and each of them needs to be looked at. And each of these solutions could improve efficiency gains and improve the way the system works. Again, here it's really a question of closing those gaps in between risk perception, which is very high, and the real risk, which is actually quite low. It's low in Côte d'Ivoire, it's low in Nigeria, in Ghana and Senegal, just as it's low in the rest of the world. So we've put together a few clues, really. These are paths that can be taken, and of course we're going to continue to talk about these things. It's our view that these are quite technical subjects. The more we talk about them, the more people will be aware. And the more people who are involved in the application process will know about the system to apply. There will be more progress made. And we can see this little by little in the quality of what is offered. That's, I think, what I wanted to say there. I hope that's given you some information. Now, what we're going to continue to do with this kind of study is really to get into the heart of the matter in different regions. And this will allow us to work on the specific conditions in different regions without, of course, forgetting the cases that we've already worked with.
Oui, nous regardons, il y a une question.
Yes, we have a question online. Could someone read that for me?
Ce serait bien. Would you like to read it?
Sure.
Yes, thank you. So Joshua asks very much for the wonderful presentation. Shed light on a previously understudied topic. And my question relates to the trade volume impacts of the individual counterfactual scenarios as opposed to the combined scenario. If I'm interpreting your results correctly, for the most part, the increase in trade under the combined scenario in the ECOWAS 4 region is greater than the sum of its parts. So in other words, the sum of the effects of providing more extensive trade financing and reducing trade finance costs to advanced economy levels. From a policy perspective, does this mean that it is optimal to employ all the necessary tools to improve the trade finance environment rather than only use the individual tools? So I think that's an excellent interpretation of the results, because indeed there is, I think, complementarity in the policy measures. So if you raise the access to trade finance and at the same time reduce, for example, the cost of import and export loans or the cost the LC fees, so the letter of credit fees, then these two, they are going to reinforce each other. So if you operate on lower cost of trade finance and then you increase the share of trade finance you have access to, then you're going to have an additional effect. So I think this is an excellent remark, an excellent question.
And a short answer. Une question ici de Mustafa.
Thank you very much, Mark, and thank you very much, colleagues from WTO and from IFC. Dennis, good to see you. I have two quick questions, more from my colleagues from IFC, because I can have questions to my WTO colleagues at any time here. And I have some, so I will have time to discuss with them. But my first question is regarding access to finance in Africa. I was listening to the presentation and I had this question: is AFDB, for instance, the African Development Bank or Afrexim Bank, doing enough in terms of access to credit and facilities also to provide, for instance, you have seen that Afrexim Bank just but guaranteed $1 billion for trade and finance activities within the CFTA. So I would like to hear from your own perspective, from IFC perspective, the role of regional organizations, banks, particularly in Africa, in terms of also ensuring access to finance. And my second question is also very much related to climate finance. We just came back from COP27. IFC was also very much present there. I follow some of your initiatives there. In terms of access to credit, is there any also options for MISMEs, SMEs? For instance, we are talking more and more on innovative finance, and Mark mentioned it very brilliantly, this dimension. So debt for nature swap or these kind of things to support also access to finance in terms of offering a low interest rate, but at the same time protecting environment. Are there any concrete options you can recommend here in terms of follow-up actions? Thank you.
Okay, so thank you very much for those questions. So the collaboration between the MDBs in the trade space is remarkable. Actually, we have a very frequent dialogue with our colleagues at AFDB and at Afreximbank, and really we commend everything that they do. We're seeing an increase across the board of demand for support. And just to give you an idea, last year, IFC alone did finance 3 billion of trade transactions in Africa alone, and 10 billion globally, just to give you an idea of the magnitude. And our colleagues from Africa Development Bank and Afrexim have also seen a large increase, which requires a deployment of activities across the continent. So definitely everyone is focused on the same objectives and increasing access to finance across the continent. Regarding your second question on climate finance, we are at the beginning of looking at those opportunities. And we have at IFC an official list of goods exchanged which qualify as climate smart. And we monitor now very, very closely how much of our business is focused on trade of climate smart goods. And we see this percentage increase over time, and we're still trying to do more. So that's on the trade side. It's still, you know, a small percentage of our activities, but it's definitely one that we are encouraging. Do you want to add something?
Yeah, perhaps just a couple of thoughts. So one, I think what Natalie was describing in very concrete terms is the fact that, you know, the pie is large enough for everybody to contribute, or perhaps more accurately, the size of the challenge is so large that there's a space for every multilateral to play a role. So I don't think it's fair to say that actions by any one player are enough, because as we see from the results in the study, the potential increase in trade is quite large, and I think whatever we do from these kinds of models, we also know that it would be a lower bound. So I think that's the first point. We can all do more, and then I think in terms of the climate finance and providing, you know, as you mentioned, access to affordable finance while also achieving other goals. Of course, I think that is the target. At the same time, and there are a number of instruments that come in to enable these kinds of things to happen, including blended finance and other types of instruments. But I think here, what is important is also to have a longer term perspective. You know, I think ultimately what we're all working towards is to have these kinds of opportunities be more commercially available. You know, the multilaterals should not be in a position where these interventions are there in perpetuity. I think our role is really to address market failures, to bring in some of these externalities which currently constrain, for example, access to finance that also has the climate goals. So ultimately, we do expect to see that there would be instruments that the private sector itself would deploy and allow the limited funding that the multilateral institutions and others can bring into this to focus on other types of goals.
Are there any other questions from the floor or from the online participants? So if not, then I suppose this concludes our presentation, and I would like to thank very much the participants who have been sending questions and attending online, as well as those who are here in the room. Thank very much the translator as well, as much as the presenters today. And thank you very much, and looking forward to see you on the presentation of the next report. Thank you very much. Goodbye.